Microsoft is on our updated 2022 watch list, and today I'm going to walk you through our investment evaluation process where we will conduct a quick company health check and run the numbers to do an intrinsic value calculation of Microsoft to determine our strike price. We've got a lot to cover today, so let's dive in. As value investors, we believe that when you buy shares of a company, you aren't just buying some random stocks that are numbers on a computer screen, but instead you are becoming a partial owner of that business. Therefore, we always start by looking at the company's story and financial fundamentals. And this is especially important when we think that there may be an economic downturn in the near future. When it comes to the story of the business, in order for us to even consider investing in a company, it needs to be a business that we understand, a business with honest and capable management, and a business that has strong, durable competitive advantages. These are all things that will keep the business healthy and protect our investment. Now, we've done a good amount of research into Microsoft's story, and those boxes are checked for us. If you want to do your own research, I will link some good resources for you in the description. Now let's talk about the financial fundamentals of the business. These are facts, numbers that are publicly available, which are going to tell us a lot about how well the company's management allocates capital, the growth potential of the business, and how well they preserve shareholder value. So now it's time to head over to the computer and pull up our valuation cheat sheet. Chris and I have been looking at tons of companies lately, and so we wanted to streamline our process and keep really accurate records of the companies that we have assessed. So we redesigned our cheat sheet, which now matches our 2022 valuation process. Okay, I'm on the first tab and I'm ready to work through the company health check data section. To get the information that I need in order to fill out my cheat sheet, I went online to morningstar.com. We prefer the Morningstar website because it is free and it usually has company data for about the past 10 years for most data sets. And to access the specific information that I'm looking for, I type the ticker symbol into the search bar in the upper left corner and hit enter. Now I click on the Key Ratios tab, and then we see here this link for full key ratios. Click on it, and it's going to take us to the various pages that have all the data we need in order to fill out our cheat sheet. And this is where I'm getting my numbers from for this section of the video. The first thing that we want to check is the company's ability to pay down debt by looking at how many years of free cash flow it would take to pay off their total non-current liabilities. The lower the number, the better, but as a rule of thumb, we really like it when a company can pay off their long-term debt in 5 years or less. And if they can't, it's really our cue that we need to dig in deeper to understand why. Debt can kill a company, especially if their cash flow is negatively impacted, like it very well could be during a recession. Quick side note, for big companies like Microsoft, most of their financial data has numbers in the billions. However, when you look on sites like Morningstar, they actually report in millions. So for the rest of this video, I am going to say my numbers just like how they show up on the website. So please don't think that I'm a ding-dong if I say something like 103,000 million. Okay, so last year Microsoft had 56,118 million in free cash flow, and in the trailing 12 months, it is at 63,649 million. So in the past, we would usually just use the TTM figure. However, these days, Chris and I are anticipating a market downturn. So we are being even more conservative in our process. And you are going to see me apply this conservative approach throughout this video and all the other valuations we're sharing as part of our updated watch list series. So we're going to use a nice round 56,000 million as our conservative assumption for free cash flow. Okay, now we just need to enter their total non-current liabilities, and for last year we see that number is a little over 103,000 million, so that's what we're putting into our spreadsheet. When we divide 103 by 56, it tells us that it would take Microsoft a little less than 2 years of free cash flow to pay off their long-term debt. That is a great ratio, and that gives us our first check. Moving on, we want to see if they have a strong return on invested capital, or ROIC. So this is the cash that they earn on their debt and their equity, and we generally like to see something over 10%. On Morningstar, I found that in 2021, the ROIC for Microsoft was about 30.8%. This is absolutely fantastic, and it's our second check. Now let's talk about growth. We like to see their revenue, net income, and most importantly, cash flow in a general upward trend. So in my table, you can see that I have entered in the data for 10 years ago and for last year, and across all three metrics, they have had growth. Another big check. Next, we're going to take a look at their shares outstanding to make sure that they're not diluting the shareholder. You see, unlike a stock split, issuing shares actually reduces shareholder value. It's usually done by companies that are needing to bring on cash in order to continue operations or grow the company. Now, we prefer to invest in companies whose cash flow can do that. 10 years ago, their shares outstanding were 8,506 million, and today they are at 7,559 million. So that shows us they have consistently been buying back their shares over the last decade, and this is another check. So the last thing that we're going to look at is the safety of the dividend, which is currently yielding about 1%. So to understand this metric, we are going to compare the amount paid in dividends with the same free cash flow number that we used earlier, because we want to see how comfortably they can actually pay out these dividends. We can get the essential data that we need from Morningstar, but we've got to do some quick math in order to get the final information that we're looking for. Online, we find 236 in the dividend row and TTM column, and this number actually represents the dividend you will receive per share. So to figure out how much Microsoft paid in total, you just have to multiply 236 by the shares outstanding, which we already know is 7,559 million. And the multiplication shows us that in the trailing 12 months, they paid out approximately 17,800 million in dividends. If we compare this against the 56 million that we're using as their conservative free cash flow, I'd say that their dividend is pretty well secure, as they're only using about 32% of their free cash flow in order to pay their dividends. And that gives us another check. Looking at our summary table, we can see that Microsoft has a clean bill of health based on the metrics that we've used. And Chris and I actually set up our Excel to auto-populate green and red based on our guidelines. So once we're done entering in all of our health check data, we have a really nice visual summary and a quick notes section that we can refer to at a later date if needed. Okay, here's where the real work begins. Before we can do the final strike price calculation, we first have to decide what number we are going to use for the expected growth rate of the company. And I would argue that the growth rate is the single most important number that we're going to plug into our valuation calculation, and it's also the most subjective. Different investors have different ways of figuring out this number, but because it's so important, Chris and I like to do a little bit of extra work here. Essentially, we are trying to make a prediction on how we think the company is going to grow over the next 10 years. And to start, I'm going to look back on the past 10 years to try to get an idea of how they might perform in the future. I'm now onto the second tab of our cheat sheet, and I'm going to calculate the historical growth rate in two different ways based on the historical data for the free cash flow of the company. First, we're going to use an equation to calculate the annual growth rate, and then we're going to chart the cash flow numbers. And as a starting point for both methods, we pull data from Morningstar to plug in the correct numbers for free cash flow for the past 10 years. And for Microsoft, it looks like this. Now we can simply apply the compound annual growth rate formula, which you see here on your screen. And we like to embed this formula into our Excel sheet. Using the CAGR formula, we get 7.5%, and I want you to notice that the equation is pulling numbers from the cells that show you year 1 and year 10. I think this is a really decent starting point for figuring out the historical growth rate, but the problem with this method is that it only compares year 1 and year 10, and it ignores all of the numbers in between. So if you are only going to use this method, please make sure that the numbers you plug in are not outliers, because if they are, this can really mess up your calculation. And this leads me to method number 2 that we like to use for calculating the growth rate, and that is to plot it in a chart. Using the same 10-year table as the data source, we embedded a scatter plot chart with an exponential trend line that shows the equation. From here, all you have to do is look at the exponent of the equation and move the decimal places over 2 spaces to the right, and that gives you your percentage. And this method gives us a result of about 8%. Chris and I really like this method because we feel like it is more complete, and it gives us a very good visual representation of how the company has performed over the past decade. And it makes it very easy for us to see if there are any outliers. And if we see years with outliers, it can trigger us to be like, oh, we need to research and figure out more about what happened during that specific time period. The only thing to be aware of is that this methodology only works if all of your numbers are positive, so be careful and watch out for that. Okay, so looking at the numbers we have just calculated, the results are pretty similar. As you know, I really like to be conservative when it comes to our calculations, so my instinct is to just use 7.5%. However, I want to add a third layer of assurance, so I'm going to head over to Yahoo Finance to check out what the analysts are predicting for the growth of Microsoft over the next 5 years. And after doing a quick survey, I can see that the average analyst is saying about 16%. So 7.5 may seem a little bit low to some folks, but to be honest, I really don't care. That's what I'm using because it's my money and that's what I feel comfortable with. Before we move on to the next step, I just want to say that it's really important to remember that past performance is no guarantee of future results. So it's really important that you add narrative to the story that the numbers are telling you and that you back it up with thorough research. And the way that you do this is by reading the annual reports, listening in on earnings calls, and watching interviews that the management gives in order to have insights into the future of the business. You want to do your best to understand the company's products and services, their customers, their competition, etc. Basically, you want to research until you stop learning new things about the company. All right, we are finally ready to start the valuation process and determine our strike price. This process is essentially our attempt to predict future value to decide what we're willing to pay today for those shares. It involves doing some calculations, using key numbers, and making some informed judgments. And it is so important to determine the value of a stock before you invest in it, because that's what's going to protect your investment for the long term. Remember, price is what you pay and value is what you get. And we want to know the value of a company before we invest in it. There are several ways to do an intrinsic valuation of a company. Chris and I prefer using the discounted cash flow method, so that's the method we're going to use to value Microsoft today. And I'm going to use a terminal multiple after 10 years. This means that we are going to forecast the cash flow for each of the next 10 years, and we will assume that we will sell the company and collect a lump sum. Then all of these cash flows will be discounted back to a value of today by our desired rate of return. This method requires 5 key numbers: shares outstanding, free cash flow, expected 10-year growth rate, free cash flow multiple in 10 years, and your desired rate of return. Okay, let's start with the easy stuff first. We already know a few of these numbers from our health check and the work that we just did to determine our growth rate. So let's plug them in now. Shares outstanding, 7,559. FCF conservative assumption, 56,000. And expected 10-year growth rate, we are going to use 7.5%. All right, and now we're on to our fourth key number, which is the free cash flow multiple in 10 years. And basically what we're trying to determine here is the free cash flow multiple that we assume Microsoft is going to have in 10 years when we're assuming that we would sell the business. And for this, I'm going to head over to macrotrends.net and look at Microsoft's historic price to free cash flow. And I can see it has gone between 10 and 40, and it has spent most of its time above 15. However, I'm going to use 15 for our calculation because as a rule of thumb, 15 is as high as I will ever use for a multiple. Maybe if I really think that a company has lots of room to grow, I might go a smidge higher. But in the case of a company like Microsoft, which is already a huge company, I think that 15 is as high as I would feel comfortable with for this calculation. And now we just need to decide what desired rate of return we want to have for this investment. And this is highly subjective because ultimately you're deciding how much of a return you want to get. And in this case, I'm going to use 15%, and that is usually our go-to rate. Now, for some of you, that might seem high. For some, it might seem low. The reason that Chris and I like 15% is because we know that if we were to just invest in the S&P, that historical return rates are around 10%. And so because we're taking on all this extra risk and also doing tons of extra work in order to invest in individual companies, we really want a return that is higher than 10%. This is what our cheat sheet is looking like with our 5 key numbers. And with this, we can now do our valuation. And remember that we are using the discounted cash flow method. And this means that we are going to use this method to estimate the value of our investment based on its expected future cash flows. A discounted analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. So off to the side, I've made a table and I've labeled it from year 0 to 10, and I've listed year 10 twice because that is our terminal year. In year 0, we put the FCF value of 56,000, and this equation will grow this number each year down the line using the growth rate of 7.5% that we have entered here. Now remember, the second column showing 10 is there because this is the year that we will assume we will sell the business. So in order to get this number, we have to take the free cash flow of year 10 and multiply it by the free cash flow multiple in 10 years, which in this case is 15. And this is what the equation looks like in our cheat sheet and the result that we get. Now we can work on our bottom row, which is where we figure out today's value using the present value formula that you see on your screen. Once again, we have embedded this into our spreadsheet and we just start with year 1, and this is what the formula looks like. Now what we need to do is add up all of these numbers and we get a total value of $820,488. And now there is just one more step to figure out our strike price. But before I share our final strike price with you, I just want to remind you that I'm not a financial advisor, and I am definitely not your financial advisor. The purpose of this video is simply to share what we are personally doing, and it should not be taken as financial advice. All right, without any more delay, all we have to do is take this number and divide it by the shares outstanding, which in this case is 7,559. And this gives us a strike price of $108.54. So that's it. Our strike price is $108.54. On the day that I'm filming this, Microsoft is trading at right around $255, so it's way overvalued for us at this time, but we are going to continue to watch it and be ready to sell put options and buy shares when it's near our strike price. Chris and I believe that there are going to be lots of great investment opportunities popping up in the coming months, so be sure to check out our other valuation videos if you want to stay up to date with what we're doing. Would you invest in Microsoft? And if so, what's your strike price? Remember, earn more, spend less, and invest the rest, and I'll see you next time.